Tesla is straight up bankrupting the competition. In this video, we're going to review how Tesla is bankrupting the competition, and we'll start by looking at a used car dealer, followed by a couple of other very popular EV manufacturers. We'll go ahead then see how Tesla might be shooting itself in the foot thanks to a margin preview that we get for Tesla. We'll also look at an earnings preview. We'll understand what's going on with car rental companies and Tesla. We'll take a brief look at Twitter regarding its profit problems and debt and how that could affect Tesla. And then, of course, we can also not end a Tesla video without talking about the lawsuit over potential Elon Musk fraud or defrauding investors for his tweet from 2018. Hey everyone, me Kevin here. We've got a lot to cover and hopefully we get done before December, well, we're already in January, before January 30th, which is when the coupon code link down below expires, and that will be the best price available for at least 3 months guaranteed for you. After that, the prices on Building Your Wealth go up, and once you're in, you have lifetime access to all of the course member live streams that we do and the archive of course member live streams. Check those out, link down below. First, let's talk about how Tesla is bankrupting the competition. First, let's start by looking at what the car dealership guy says on Twitter. He says, here's a Tesla Model Y listed on Carvana for $12,600 more than a new car. Carvana's management literally asleep at the wheel, he says. Now, I had to personally fact check this because I found it remarkable that a Model Y that's used with 14,000 miles would be listed for more than a brand new Model Y. So what did I do? Well, I went to Carvana's website, typed in Model Y, and sure enough, I can overpay by about $7,000 for a last year Model Y with about 2,500 miles, given that the current new price of a car, a Model Y, is sitting closer to $52,000. In fact, you could see that right here. This is the Model Y long range, $52,990, and this is not on the potential savings tab. It is under the actual purchase price tab. So just remember that number for a moment. $53,000 is roughly the new price, right? And if you zoom out, what do you get on the Carvana website? You end up getting these vehicles sitting here for $59,500 for the Tesla Model Y long range, Tesla Model Y long range, $55,900, 19,000 miles almost. Here's another long range for $57,000, 5,000 miles, a 2022. Here's a 2021, 13,000 miles, basically the same price as new. And it makes you wonder, what is Carvana thinking? Why would they not appropriately adjust prices so that way they could actually maintain a competitive edge for their used vehicles? And car dealership guy actually suggests that this is exactly what CarMax is doing. In fact, CarMax dropped prices immediately after Tesla dropped prices, and they sold 57% of their entire Tesla inventory in just 24 hours. And as of the next morning, the stock continued to fall. So the car dealership guy paying attention to this. Now, we did notice that vehicle prices have started getting dropped by Carvana on Teslas, but again, if you go to the main inventory page, you still get a whole host of vehicles that are actually showing as more expensive than Teslas now after the Tesla price drop. Now, that's quite remarkable. And so it made me wonder, oh my gosh, what if Tesla is actually bankrupting these companies? So what I wanted to do was jump over here. I went to the Carvana balance sheet, and I went ahead and did these numbers for us already. And what I did is I took their balance sheet, which is right here as of September 30th, 2020, and I made some adjustments because I want to see how close to bankruptcy this company actually is. Keep in mind, if you search on YouTube, Meet Kevin Carvana, you'll see that I've already been covering the bankruptcy story for Carvana for a while, and I think this is an incredibly dangerous stock to hodl. They also just adopted a poison pill, which honestly is quite ridiculous. They don't want anybody to adopt more than a 5 or buy into more than a 5% position for Carvana stock because they're so worried about being taken over for some reason. But their excuse is absolutely hilarious. And then I'll show you the balance sheet. Look at the excuse that they're giving. They're saying here that Carvana wants to preserve the ability of Carvana to basically take tax benefits from loss carry forwards. In other words, if you lose so much money that you're so good at doing nothing but losing money, like let's say you lose $100 million, or in the case of Carvana, maybe a lot more, then in the future, if you make, say, $10 million of positive revenue, you might be able to carry forward some of these losses and offset your income to where usually if let's say you made $10 million of income, you might have to pay $2.1 million in corporate taxes, right? About 21%. But because you have all these losses, that actually becomes an asset. So in some twisted, perverted way, this loser of a company is trying to preserve their leftover asset of potential tax carry forwards. So that way they could say, hey, look, we made money again. Now we don't owe those taxes. This is kind of like the Amazon mentality where it's kind of like, hey, we've lost so much money in the past, we shouldn't have to pay any taxes on our new income. It makes sense. That's called entrepreneurship and capitalism and the way the tax structure is set. But what's fascinating is Carvana is basically telling the world, hey, because we are so good at losing money, we do not want anybody taking control of more than 4.9% of this company. And as soon as anyone does, we'll basically just do a stock split, basically giving everybody 2 shares for 1 share that they have, except for the person who took more than a 5% share. So in other words, they instantly get diluted down to about 2.5% ownership as soon as they go and hit 5%. Now that's pretty wild, and this is called a poison pill, and the excuse they're using for this poison pill is we're so good at losing money, that is now an asset. Okay, fine, but now we need to actually try to understand what's happening on their balance sheet, because it'll show you how Tesla is actually forcing deflation by basically bankrupting the competition. And it ain't just Carvana, okay? Watch this, okay? Let's go over here and let's take the green column and say that's Carvana's vision of their assets. Carvana wants you to think they have $9.6 billion in assets. That's this piece right here. They want you to think they have $9.6 billion in assets. So what I'm gonna do is I'm gonna go in here and I'm gonna add up things that I think matter. I'm gonna take their cash position, I'll take that. I'm not going to give any value to their restricted cash position because this is probably going towards new cars that they're probably going to lose money on anyway. So I'm just going to be a little conservative and take that out for a moment. Anytime I do critical fundamental analysis, I like to be very conservative, right? I want to know the worst case scenario. So I'm going to be a little bit more aggressive here. I'm going to give all financing and vehicle inventory that they are trying to sell, like loans or cars they're trying to sell, a 20% discount. So rather than giving them $2.5 billion for car inventory, I'm only going to give them $2 billion. Rather than giving them $485 for loans held for sale, I'll give them $400. All right, fine. I'll give them their beneficial interests in securitizations, but these other current assets, you know, I'll carry those forward as well. That's fine. But because of these discounts, I'm only going to give them $3.7 billion of actual current assets. When it comes to long-term assets, I'm going to remove anything I think has no value. Plant, property, and equipment, these are like car vending machines and Carvana car transporters and Carvana branded software. I think this has virtually no value in the event the company goes bankrupt, or it would have some really low liquidation value. So to be safe, I'm going to say this has no value. Their leases have no value if they go bankrupt. Their intangible assets or their goodwill, like their trademarks and their brand, have no value. And these other assets due from related parties, I went ahead and even though I wrote no value, I gave them that 214 anyway. So now when we look and subtract their plant, property, and equipment, their goodwill and their brand value and their trademarks and all this stuff that really doesn't matter, what we end up with, this is lease, right? And anyway, these things have no value. What we end up with is a company that actually only has total assets of about $3.9 billion. They say they have $9.6 billion. But because they're knocking on the door of bankruptcy, I'm going to be very aggressive here. When I add up their debts, I get roughly the same number that they do in debts, about $9.1 billion. That means Carvana, in my opinion, has negative shareholder equity of $5.2 billion. They're so far upside down. They're trying to tell the world, no, we have at least $374 million of equity, but they're propping that up with stuff that's valueless, like their brand, which there isn't really much of one left, and they're not doing a good job on their website of preserving that thanks to Tesla's price drops. And so really what you're creating here is a company that's going bankrupt. Now, you don't have to look too far down their third quarter income statement to realize they're screwed. While yes, they actually made a gross profit of $359 million, selling about $2.5 billion worth of vehicles in wholesale and to retail, that $359 million gross profit gets eaten up by more than $153 million of interest expense and SG&A expenses exceeding $650 million. That's a lot. And so it's no wonder why they're losing $500 million a quarter, or at least this last quarter. They were doing better last year, obviously. They were only down $68 million, but even last year they weren't even profitable. And over the last 9 months, they've lost basically $1.5 billion, 1.452 to be exact, but that's roughly 500 mil per quarter that they're burning. But wait a minute. If we actually go to their balance sheet, we don't have 500 mil in cash. Exactly. That's because the company's going bankrupt, and Tesla just contributed to that by basically forcing all used car companies to increase their discounts on their existing inventory substantially, pushing companies like Carvana closer to bankruptcy. But it's not just Carvana that's getting pushed closer to bankruptcy, it's also other manufacturers. Look at Arcimoto. Arcimoto, money-losing company. I've interviewed the CEO before. I've posted my criticisms online before. Type into YouTube, Meet Kevin Tech, Arcimoto, and you'll see my most recent interview. And you'll see that money-losing companies, if they can't turn a profit in a recession, have to resort to selling stock on the stock exchange. Well, when they do that, they substantially depress the value of their stock because there doesn't tend to be a lot of buying liquidity. So what ends up happening? Well, you end up getting, unfortunately, a company whose CEO I like, but it's not a company I would invest in. You get a company like Arcimoto dropping 58% in a day. Yikes, because they have to dilute their shareholders. But it's not just companies like Arcimoto, it's companies like Rivian. Let's look at Rivian for a moment. Here, you have a company that in 2022 is generating $500 million of revenue, but their costs to achieve that revenue are $1.4 billion. That's gross profit of negative nearly $1 billion. So in other words, it costs them $2.71 to make $1. And we're not even talking about operating expenses yet, which are running at $857 million. Rivian is next to have to raise a lot of money. Unfortunately, it gets not much better when you look at the Rivian balance sheet. Yes, they have about $13.2 billion in cash. Yes, they only have about $2 billion in payables. That gives them about $11 billion in free cash. That's fantastic, and they're going to need it because when we go over to the cash flow statement, we could see that unfortunately their operating cash flow is negative $3.6 billion in 9 months. Plus the investments, the CapEx they're spending of about $1 billion, you're looking at about a $4.6 billion burn, and they have 11. That gives them about 2.3 years before they run out of money. Unfortunately, you don't want to get close to running out of money for when you start raising money. So in my opinion, Rivian is another one that if they continue on this course of losing money for every vehicle they are manufacturing in the ramping process, yikes, you're potentially looking at bankruptcy. Now, don't get me wrong, and I've done this comparison before. You could actually go on YouTube and just type in Meet Kevin, Tesla versus Rivian versus Lucid. If you go back and you look at Tesla at roughly the similar amount of production as where Rivian or Lucid sits now, guess what? Tesla was making a profit per vehicle. Not a large profit, but a profit. When you look at both Rivian and Lucid, they are burning money substantially. We're not even close to profit. And by Tesla reducing prices, you're putting even more stress on these margins. That's Not very good. In fact, if you jump over to the Lucid earnings report, what you have is you have $195.4 million of revenue. And what's their cost of revenue? 492.4 before you get to operating expenses. So another example where you have a company spending $2.52 to make $1, and Tesla dropping their prices does no good for used car companies, Rivian, Lucid, even Ford. Ford can't even manufacture an electric vehicle with a positive gross margin. They're negative on producing Mach-E's. They lose money on Mach-E's. That's insane. So what do you end up with? You actually end up with a strong likelihood that as long as Tesla can survive this recessionary environment, the competition is going to be beaten to death or near death. They are going to have to raise so much money and dilute their shareholders so much that they might have to delist from stock exchanges or go bankrupt. Now, it's not to create fear or FUD for other companies. It's just to say when Tesla cuts prices, other companies freak out. The reason why after Tesla cuts prices, Xpeng and NIO stock fall, Ford and GM stock fall, Volkswagen and BMW stock fall. It's because everyone is worried that the entire industry is going to compress. And given the fact that the biggest Chinese auto manufacturer, known as BYD, makes just $1.45 for every $100 of income they receive, whereas Tesla brings $14 to the bottom line for every $100 they sell, you have a lot of concerns that the entire EV manufacturing world is about to get shifted down, which means, yes, Tesla margins are going to go down, but the rest of the EV sector goes negative. And that means Tesla might be one of the few survivors who's actually able to expand during this recession. Unfortunately, as we talk about expansion on one hand, we also have to be realistic that yes, Tesla is unfortunately going to suffer some kind of margin compression. And this is where it's worth looking at Bloomberg's estimate for Tesla's margin compression. So what we're going to do is we're going to jump on right over here, and we're going to look at what Bloomberg suggests. Bloomberg believes that the price war that Tesla is creating is going to significantly hurt Tesla as well. It's not like this video is just to say Tesla's going to be good, it's gold and everything's fine. It's unfortunately not great. Even though Tesla has the highest likelihood, in my opinion, of being one of the winners in the EV space, it's going to get dragged through the mud. It's kind of like going into the pig den, beating up all the other pigs, and you're still muddy and stinky and full of poop. Even though you won, you still kind of lose, right? So, Bloomberg suggests their first estimate at gauging how much of a margin impact we're going to see at Tesla is about 380 basis points to consensus gross margin. However, it could be as high as 450 basis points. That could end up being offset by more operating leverage, lower raw material costs, maybe the introduction finally of the Cybertruck, but at least in the near term, you're expecting to see a margin hit at Tesla, even as it likely gains market share from the competitors. Now, in fairness here, Bloomberg actually hands it to Tesla and suggests that, look, Tesla is actually pretty competitively priced against cars like the Mercedes GLC or the Mach-E. And the biggest ones to be worried about are companies like Rivian and Lucid, who are bleeding cash. At least companies like Ford and GM have balance sheet flexibility, including Honda. But balance sheet flexibility just means, I guess we can lose money to try to survive and keep selling some EVs so we don't get completely beaten out of the market. But look at this. Price comparisons from Fisker show that a Tesla Model Y at its new $53,000 price is very competitive to a Mach-E or a Mercedes GLC before any potential tax considerations like tax benefits for the EVs thanks to the Inflation Reduction Act. That's actually a really good plus for Tesla, because now with its new pricing, we expect Tesla is going to be able to take advantage of a lot more of that sub $55,000 full $7,500 tax credit. See, Tesla's full self-driving is actually billed separately from the base model of the vehicle. And even though you might be able to include FSD in your financing, it is not included as an optional upgrade for the purposes of determining whether or not you could get the tax credit. That actually potentially means you could have a lot of Tesla buyers who say, wow, I'm paying $53,000 for the car. How much is FSD? Oh, 15 grand, that's a lot. Oh, but wait, I get a $7,500 tax credit. Maybe now do I want to buy FSD? Maybe, and it likely will increase the take rate for FSD, especially since now people can actually get the full self-driving beta in a wide release. That's great, and once again, reiterates Tesla's ability to just beat up the competition and take more market share. So far, we've talked about the fact that Tesla is bankrupting companies. We've talked about them potentially bankrupting used car dealers like Carvana. And we've also talked about Tesla's potentially shrinking operating margin, even though that means they're going to be kicking the competition's butt in terms of market share. So what does that shrinking operating margin look like? Well, if we take the Bloomberg estimate of a reduction of basically 3 to 5% on Tesla's operating margins, what we're going to want to do is probably take Tesla's present about 27 to 25% margins and drop these to, probably to be safe, about 20%. So we're going to say the gross profit on Tesla vehicles is only 20%. That's an 80% cost, right? And let's use a forward projection of a $47,000 revenue per vehicle with 4.2 million vehicles by 2025, which obviously could be vastly off, but we think is relatively reasonable, especially with the Gigafactory expansion we're seeing. Now, if I assume a 19% take rate on FSD, which is, in my opinion, low, because that's what we had in 2020. We had a 19% take rate. That could be higher, in my opinion, be closer to 30%. But let's go ahead and assume 19%. That probably puts our fair value for Tesla at a PEG ratio of 1.67 at about $481 per share. At Tesla today, around 120, that represents about a 59% compounded annual rate of return over the next 3 years as we get out of a recession again. Let's go ahead and be generous, though, here to valuations and remove Tesla FSD completely. Let's assume Tesla makes zero money from FSD and margins are 20%. You're still looking at a company that should sell for $350. And if you think a PEG ratio of 1.67 is too high, let's go with a PEG ratio of 1 at a 30% growth rate. That would be a 30 PE ratio, bringing you still yet to a $210 price target or a 20.6% compounded annual rate of return for the next 3 years. So even with this margin compression that Bloomberg is projecting, Tesla looks like a steal of a deal. And there's a reason why it's one of the largest positions in my personal portfolio, though I want to be realistic. There is bad news. Now, there are some nice things, like Morgan Stanley says, we believe a floor in earnings must be reached before investors get comfortable with the floor in the valuation. Now, the reason I say that's nice is because we have an earnings call coming up in 1 week from Tesla. I personally agree with this analysis, that it's quite likely, in my opinion, that in 1 week, once we actually get those Tesla earnings, whether they're good or bad, we'll actually have insights. And usually what happens is when you get answers and insights on a company or on any kind of negative catalyst, some element of fear goes away and you potentially unlock buying. Morgan Stanley maintains an overweight rating with a price target of $250 on Tesla. They suggest that the global EV market is experiencing a transition from undersupply to oversupply. And they believe that 2023 is a year during which execution on manufacturing costs and supply chain management will separate the winners from the losers. I've just broken down quite a few losers and shown you why Tesla wins in almost all of these categories against all of the competitors. Whether it's sales prices or it's margins or it's a net income, Tesla wins across the board. Capital self-sufficiency may also be tested during a time of negatively reset expectations over the next few years. This is a way of saying if you're not making cash flow and you have to go to the market to raise money, you're going to end up like an Arcimoto, where you're down 60% in just a day because you had to dump a bunch of shares on the market just to be able to survive. That is a problem. But not only that, it's worth looking at analysis from Goldman Sachs. Goldman Sachs talks about the recently reduced prices in several geographies, including the US, Europe, and China, anywhere between 6 to 20%. And they suggest that while reduced prices for the Model 3 and Y help the company better address the 20 to 30% of vehicles sold in the market between the 40 to 55K range, basically opening up your market share, ultimately, the price cuts may imply that orders were tracking more weakly than expected. Therefore, Goldman Sachs is lowering their EPS projections and they're reducing their average selling prices. Now, they've already been lowering their expectations for earnings per share and the growth rate for Tesla, but now they're lowering them even more. Despite this, Goldman Sachs believes that even though we're going to have lower earnings in the near term, they think they're going to see Tesla take more market share, which is what we've been talking about, and they think that Tesla's new factories, including Austin and Berlin, will end up having margins that closely resemble Shanghai, or more closely resemble Shanghai than they resemble Fremont. Shanghai we know to have very, very high margins. And so Berlin and Austin ramping should help increase margins for Tesla rather than only seeing margins go down thanks to price cuts. This is what happens when you scale. Maybe that'll happen for Rivian and Lucid as well, but they have a long way to go to even make a dime of profit. They're not even close yet. They also think that Tesla's ability to make a profit while lowering prices basically wrecks the competitors, in their opinion. This is something we talked about earlier as well, so it's not just me saying it. Now, their earnings per share estimate is only $3.50 for 2023. Now, that actually makes Tesla look a little bit more expensive than usual, because if you look at $3.50 at about $120 a share, let's say, that puts you at about 34.2 times price to earnings ratio for 2023. And if you have a 30% growth target or growth target for Tesla, that actually puts you somewhere around a PEG ratio of 1.13. Most people have a price or growth target, I should say, for Tesla of around 40%, in which case you'd be at a PEG ratio of about 0.85. If you have a growth target eventually for Tesla of 50, you'd actually be at a PEG ratio of only 68. So it all comes down, obviously, to your growth target for Tesla. In addition, Goldman Sachs believes that the recent weakening of the US dollar mitigates some of the damage of the international price reductions. You have to remember that Tesla sells or receives about 45% of their revenue from the international market. That was really bad in 2022 when the dollar was strengthening. But now that the dollar is plummeting, it could actually be a tailwind for boosting Tesla's margins and profits. And what I actually like to see is substantially declining profit estimates because it makes it easier for Tesla to beat them. Consider the following snapshot that's been circulating on social media. You could see that 12 months ago, we had, let's see here, this is the EPS adjusted measure for Q4. And then this over here is our EPS 2022 measure. Let's just stick with the Q4 2022 earnings estimate. And you could see that 6 months ago, we thought the earnings would be about $1.24. That has then steadily declined. Actually, it went up to 129 there for a hot minute 3 months ago, but then declined back to 124, 116, 114, and the current estimate is only $1.13 for Tesla EPS. So if you're trying to track what that EPS comes in at for the fourth quarter for when those earnings come out, the current estimate is declining by the day. Right now, sitting at just 1.13. If we look at the 2022 adjusted earnings per share, we're sitting at a current estimate of about $4. And so if you wanted to use a trailing PE measure for Tesla, you would take about 120 for the share price divided by 4, and you would see that Tesla's selling for about 38. X. Now, I know you might say, wait a minute, like, isn't that less than what Goldman Sachs was predicting? Yes, Goldman Sachs actually includes only about $4 of EPS for Tesla if you exclude SBC for 2023, stock-based comp, or $3.50 for 2023 if you include stock-based comp. That's insane. Think about that for a moment. The consensus estimate for 2022, okay? 2022 consensus estimate is $4. You can see right there, $4, period, 2022. Simple. That is Wall Street's consensus estimate. Goldman Sachs is actually 50 cents lower than that for the next year's earnings per share. In my opinion, that's actually great news because it's a sign that Wall Street, once again, is probably going to be really wrong. And it's going to be quite bullish for Tesla. Now, do keep in mind, though, even the Wall Street average estimates, which are more bullish than Goldman Sachs, have growth of the following for Tesla: 13% next year, 31% the year after, 28% the year after in earnings. That means that Wall Street actually thinks Tesla's only going to grow their earnings per share at an average. This is wild, okay? Wall Street thinks Tesla's over the next 3 years only going to grow at an average of 24%. This is despite the goal of the company to grow at 50% and Tesla in a hard quarter growing at 41%. So you could see Wall Street is pretty bearish relative to the company's estimates. Now, if you don't think that Tesla is going to grow 40% or even 30%, yeah, you might align more with Wall Street or even Goldman Sachs. But the fact that Goldman Sachs here for 2023 is actually looking at what to me looks like a negative EPS absolutely blows my mind. Now, just to make that crystal clear, because I know it's like hard to imagine that Goldman Sachs could picture zero growth for Tesla over the next year, look at this chart right here. EPS projections, $3.48 for 2022, $3.50 for 2023. Yeah, Goldman projects no growth. That's insane. And this, folks, is a company that has a $200 price target. Goldman Sachs has a $200 price target for Tesla, but assumes zero growth over the next 12 months. How freaking insane is that? Hey, you know what? In the short term, you know what they say. In the short term, the market is irrational, and it will remain irrational longer than you can remain solvent. But in the long term, fundamentals tend to win. And this is why we regularly talk about fundamental analysis in my programs on building your wealth, in our course member live streams, real estate investing, stock investing, do-it-yourself property management, making YouTube videos, being a YouTuber, being a real estate agent, increasing your income in our Hustlers course, you name it. Next, we have to talk about how Hertz is actually now interested in buying 25,000 Tesla and Polestars to rent to Uber drivers for about 334 euros per week. Now that's actually quite interesting because it means that even if consumer demand slows down, if the prices of these EVs come down, you could end up finding that rental car buyers, even during a recession, might end up swooping in to pick up the inventory. And so far, it looks like that's exactly what's happening. Now we have to talk about how Twitter could potentially affect Tesla. Unfortunately, Twitter has to start making payments, at least according to the Financial Times, on about $1.5 billion of annual interest expenses. If we look at the 2021 annual report for Twitter, we could see they brought in revenue of about $5 billion. Yet they had losses of $221 million. So somehow you could make $5 billion and still lose money. That's pretty disappointing. But anyway, the company lost money. Wow. And we know that their revenues per quarter, if per quarter revenues were about 1.27, let's say, we know that their revenues right now are down by about 40%, which means this is a company that's probably making somewhere around $762 million in revenue right now. 762. If they have to pay $1.5 billion in interest, that means they have to pay $125 million in interest per quarter. Unfortunately, their expenses were insane. Even if you take out the probable one-time litigation expenses here, you're still sitting at about $4.8 billion in annual expenses. Divided by 4 puts you at about $1.2 billion in expenses. Right now, the company only makes about 762 mil. That would put them way upside down. But since Elon Musk cut about 75% of the company out, let's just assume they're about 75% expensed out, right? Now their expenses, instead of being about 1.2, might be actually closer to $300 million. Wait a minute. That's actually potentially good news, because if their revenue is about $762 million a quarter, assuming we could take the 2021 numbers and divide them by 4 and then take off 40%, we're at 762 of revenue per quarter. We're at negative 125 per month, which means we're at negative 125 times 3 for the quarter, right? Minus 300 mil for surviving expenses. What do we end up with? We end up with, let's take the little handy dandy calculator here and see if there's any more risk. 762 minus 125, minus 125, minus 125, minus 300. Oh my gosh. Oh my Lord. They could actually potentially be positive by $87 million. So even though this entire Financial Times piece is my opinion, a pretty big FUD story on how Elon Musk could potentially have to default on the debt, and then he would have to go bankrupt, and he could try to force renegotiating, and he could try to improve his position by negotiating with bankers under even the threat of bankruptcy, or he could try to take out more margin loans against Tesla, or he could try to raise more capital, which is exactly actually what they've been trying to do. If the numbers are right, Elon should actually have been able to get his cost down to where the company might be soon able to run at a break even. Even if we just assumed Elon Musk set aside $3 billion of stuff he already sold for Tesla stock, and assume that Twitter runs at a $250 million negative, that's like taking another 20 or like another third off of the revenue that I assumed for Twitter based on reports that we're getting. Okay, public reports are showing revenue declines at Twitter of 40 to 35%. Okay, if we take off another 250 here, we're probably more like assuming a 55 to 60% decline. Even in that case, Twitter would be able to survive another 12 months using $3 billion of Elon's money. This is where I actually believe that Elon's confidence in saying he will not have to sell in 2023, sell more Tesla stock, is actually accurate. So I give Elon a pass on that. Now, 2024, all bets are off. He could go back to selling, even though he says he hopes he won't have to sell until 2025. Unfortunately, then we have even more bad news. The lawsuit over the tweet. Funding secured. Long story short, in August of 2018, Elon Musk said, taking Tesla private at 420, funding secured. He ran his math assuming that Tesla is worth about $419 and some odd cents, and he rounded it up to $420 for good karma. He was doing so under the premise that the Saudi private investment fund would be willing to commit to funding the deal at $420 per share. Unfortunately, those were just talks, and in an interview with the New York Times, Elon Musk kind of walked himself into a corner when he basically said, yeah, the deal wasn't a commitment yet, it was just talk. That led a judge in California named Edward Chen, who's the same one hearing the fraud case starting today, to say, quote, no reasonable jury could find Elon Musk's tweets on August 7th, 2018 accurate or not misleading. This is the same judge who rejected Elon's claims to move the Tesla fraud case, the Elon Musk tweet fraud case, to Texas, despite Elon's claims of bias in the jury pool due to all of his layoffs at Twitter. Now, one of the jurors or potential jurors was interviewed. I don't know how they pulled this interview off, but apparently, or maybe this was reported through attorneys. That's probably the case. because attorneys interview jurors. But anyway, one of the jurors apparently said that Elon Musk comes across as arrogant and narcissistic, but they believe they could put that opinion aside in the courtroom and judge Elon Musk fairly, because after all, there are times they don't like their husband, and you don't have to like somebody to properly judge them. Let me just say that Elon Musk losing this fraud case would not be very good, because there is a risk that Elon Musk could lose a substantial amount of money in the fraud case to damages. Now, it's very difficult to prove damages because since his tweet, Tesla share prices are up 384%. But I believe the individuals involved in suing Mr. Musk for fraud are individuals who were trading based off Elon Musk's tweet. And so now there's going to be not only a jury that decides, was Elon Musk wrong for what he said? But then if he was, who decides how much in punishment he has to pay? Who decides what those damages are? And all of that is still to be determined. But if Elon Musk has to pay $1 or $2 billion, you better damn hope that Twitter is really cash flow positive. Otherwise, Elon's going to have to flip-flop again and start probably selling Tesla stock to keep both, well, his penalties alive, himself alive, his obligations alive, and Twitter alive. That's a lot of information. So, long and short of it, if you made it this far, I appreciate you. Consider subscribing and sharing. If you like this sort of longer video, please let me know in the comments down below. If you want a bottom line of the whole video, short-term bad, long-term good for Tesla stock. Hashtag not financial advice. And to the person who left me a comment the other day saying, hey, Kevin, when you say, I'm a licensed financial advisor and I run an ETF and I sell programs on selling or on building your wealth, you shouldn't say that. Oh, and final message to the person who told me that I should not say things like I'm a licensed financial advisor and even though I sell programs on building your wealth and I run an ETF, an exchange traded fund, this video is not personalized financial advice. No, I'm going to continue providing that disclosure because I think it's very fair and reasonable to the audience to know that, look, I am a financial advisor. I do sell courses on building your wealth. I am an investor in Tesla stock. And I run an ETF, which may or may not have holdings in particular stocks that we're talking about. So I'm a big fan of more disclosure rather than less. But thanks for the feedback. I see it whether I like it or not. Thanks so much. Goodbye.